Welcome to This Explainer. We're diving straight into a fascinating paradox tucked inside Gap Inc.'s latest earnings report. Now, if you follow the retail space, you probably saw a sudden stock jump for this iconic company. But as we're about to uncover, a quick pop in share price rarely tells the whole story. We're going to break down the numbers, the brands, and the big management shakeups to find out what's really going on behind the storefronts.
Here's the game plan for today's Explainer. We'll hit the main earnings headline, contrast profit with revenue, break down the core brands, look at the new CEO, check out the valuation, and wrap up with a final verdict on what this all means for investors.
Starting off with Section 1, the earnings headline, a cautious celebration.
So, when Q2 earnings dropped, the headline was undeniably overwhelmingly positive. I mean, Gap beat earnings, they actually raised their future guidance, and they returned over $700 million to shareholders. That's the good news. But, the market's ultimately cautious reaction hints at a much deeper, kind of complex story hiding just beneath that sunny surface, and it's one we absolutely need to unpack.
Moving to Section 2, profit versus revenue, the financial duality.
Okay, what's really interesting here is the solid adjusted earnings per share beat. Gap pulled in an adjusted EPS of 52 cents. That comfortably beat the 49-cent consensus by roughly 6%. Because of this, management confidently bumped up their full-year guidance, which implies a very solid 8% growth at the midpoint. So far, so good, right?
Well, here's where the plot thickens. In stark contrast to that profit beat, top-line revenue actually missed the mark. They posted $3.65 billion in revenue against a $3.69 billion expectation. Now, that might sound like a minor miss, but it was enough for management to trim their full-year sales growth guidance down to a pretty meager 1 to 1.5%.
So what's the takeaway here? We're looking at a profit story, not a revenue story. Gap is making money right now, for sure, but they're doing it mostly by slashing costs and aggressively buying back stock. Their actual top-line revenue, getting more people to actually buy more clothes, is definitively stalling out. And let's be real, you can only cut costs for so long before you desperately need organic growth. You simply can't shrink your way to greatness.
All right, Section 3, the brand breakdown, a tale of two halves.
This brings us to the absolute elephant in the room. Old Navy makes up roughly 60% of Gap Inc.'s total sales. It is their undisputed profit engine. But in this latest quarter, Old Navy's comparable sales dropped by 4%. That's the first decline they've seen in nearly 3 years, 11 quarters to be exact. Management pointed fingers at weak summer merchandise and slower foot traffic. But listen, when a brand that makes up over half your entire business starts sputtering, that is a massive red flag.
Looking across the whole portfolio, it's quite literally a tale of two halves. On one side, the namesake Gap brand, firing on all cylinders. They posted an incredibly strong 9% growth, marking their 11th straight quarter of positive comps. Banana Republic is just kind of stable with a modest 1% growth. But then we have the 800-pound gorilla, Old Navy, dropping 4%. And get this, their activewear brand Athleta plummeting by 12%. A 12% drop is a massive problem, especially considering the broader activewear market is actually booming right now. So you've got the core Gap brand holding the line while Old Navy and Athleta act like anchors dragging the whole ship down.
Which leads us to Section 4, the new CEO appointment.
The big buzz right now is Michael Francis stepping in as Old Navy's new CEO. Francis is a heavy hitter, a seasoned retail veteran with years at Target and a past stint as Old Navy's chief customer officer. He intimately knows the brand, and he knows the value retail space. On paper, it sounds like the absolute perfect hire. But we have to ask, is he a quick fix, or are we looking at a grueling multi-year turnaround job?
And here's the reality check. Old Navy's issues go way beyond who's sitting in the corner office. They are wrestling with deep-seated challenges around product assortment, inventory management, and brutal competition from giants like Target and Walmart. The stock popped on his hiring, sure, but Wall Street analysts from firms like Jefferies, Barclays, and Wells Fargo actually trimmed their price targets to the $20 to $23 range. Why? Because they want to see actual, tangible proof of execution before getting more bullish. This is absolutely not going to be an overnight fix.
Moving to Section 5, valuation and dividends, the waiting game.
So you might be wondering, if their biggest brand is struggling and this turnaround is going to take significant time, why on earth would anyone hold this stock right now? Well, simply put, you're effectively being paid to wait. The valuation is dirt cheap, trading at roughly 8.6 times forward earnings, which is historically low. They are sitting on a massive $2.5 billion in cash, and mind-blowingly, they have a 51-year track record of paying dividends. I mean, they've been paying a dividend since the bell-bottom era of the 1970s. That's incredibly rare in the volatile retail sector. Throw in the $726 million in aggressive stock buybacks this year, which is about 5% of the whole company, and you've got a seriously strong capital return buffer.
Finally, Section 6, the final verdict, bull versus bear. The battle lines on Gap Inc. are incredibly well-defined. The bullish case, it rests on that strong earnings beat, the super cheap 8.6x valuation, those massive buybacks, and that rock-solid 51-year dividend. The bearish case is just as clear. Their cash cow, Old Navy, is declining, Athleta is struggling mightily at -12%, and the overall revenue growth outlook has been slashed. So what's the verdict? Look, if you are a long-term income investor, the dividend and buybacks make the risk-reward ratio highly attractive. It's a solid hold. But if you're a growth investor, you should absolutely wait on the sidelines until we get hard confirmation that Old Navy is truly stabilized.
As we wrap up this explainer, I want to leave you with one big question. We are staring down at least 2 to 3 quarters of real volatility before we see any tangible results from the new leadership. So will Michael Francis's turnaround take hold by the Q3 report in November? Or is this retail giant facing a much longer, colder winter? Keep that question in mind as we watch how this plays out. Thank you so much for joining me to decode the data today, and as always, keep your eyes on the numbers.